All right, good afternoon, everyone. This is Joe Bacella here at Chaiken Analytics, and I'd like to welcome you to our presentation of Trade Options Like an Expert, Marc Chaikin's Best Options Secrets. Presenting today is Marc Chaikin, founder and CEO of Chaiken Analytics. Now, as a reminder, this webinar is being recorded, and a copy will be sent to everyone who has registered. Please submit your questions throughout the webinar using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. Now, before we get started, we have a special guest with us today, the founder of BigTrends.com, Price Headley. Price founded BigTrends.com to provide investors with specific real-time stock and option strategies, as well as investment education to profit from significant market trends. To get us started, here's Price Headley.
Oh, well, thank you, Joe, and good afternoon, everybody. Price Headley here, and always excited to see what Marc Chaikin has to share. You know, I've been trading options now for more than 25 years, and so it's rare for me when I can say somebody has more experience in the markets, but actually Marc has double my experience. He's been in the investment game now for 5+ decades, and truly one of the legends in the game. And obviously, when I was getting started, I was reading about Marc Chaikin's indicators back in 1990. And of course, he continues to add new innovations with his power gauge and all kinds of other tools through Chaiken Analytics. And he's talking about what I love to learn about the most and trade the most. That's options here today. So he's going to share with you today his best option secrets across his long career in the markets. And so I don't want to take up any of his time. I want to learn what he has to say too. So Marc, so thrilled to learn what you're doing with options these days on the Chaiken Analytics platform.
Price, thank you very much and welcome everybody. We have an exciting webinar today, and it's very timely because we're in the middle of earnings season and there are fabulous opportunities on both the long and the short side using options during earnings season, and we're going to share our thoughts and secrets about how you can make money during earnings season using options. A little bit of my background, as Price said, 50 years on Wall Street. For 45 years, I've been using technical analysis in conjunction with fundamentals. That's what a lot of this webinar is going to be all about, that if you're only looking at technicals and options, Greeks and implied volatility, you're missing a big piece of the puzzle, and we'll tell you why. I ran for 5 years the options department in a major brokerage firm, and I can tell you that 95% of options traders back then lost money, and that was in the 70s, and that's still true today. And we're going to give you an insight into why and show you our answer to sort of turn those numbers around. Along the way, I've been mentored by some very smart and successful institutional investors. They were clients of my institutional brokerage firm. What I learned from them is embodied in, as Price said, my newest innovation, the Chaiken Power Gauge Rating. It's a fundamental quantitative model, and it's the culmination of my life's work. So in the next 45 minutes, we're going to help you prepare for 2018, looking ahead at what to expect, how to find options opportunities during earnings season by finding winning sectors, groups, and stocks in the new year, and also how to avoid losers so you protect capital. Now, before we move on any further, Joe, could you tee up the first question or poll for the audience? We'd like to get a feel for what your favorite time to start a webinar is. We've always used the 4:15 starting time. Please let us know whether there's another time that's better for you.
All right, so we have a couple of options up there. The earlier option at 4 o'clock, and then pretty much on the 15s from there, 4:15, which is our typical, followed by 4:30, 4:45 or after. Let us know, and this will be obviously very useful for future webinars. And I see there's a lot of responses coming in. Thank you very much to everyone who's responded already. And let's go ahead and take a look. All right, I think we're doing a good job, Marc.
Well, we seem to be spot on with that. We've been doing this for 4 years now. So thank you very much for your inputs. Occasionally we try and schedule something at 8 o'clock to accommodate people on the West Coast, but it looks like we're on the mark. So we'll continue doing it this way. Now, I'm going to ask you a question and then we'll get to our second poll before we get into the meat of the webinar. Are you waiting for a pullback to put money into the market?
And we've got a couple of options here. Again, pretty much your outlook overall. Do you have more of a bullish outlook? Perhaps, I know it's pretty difficult to make the argument right now, but maybe you do have a bearish outlook too. Or let us know perhaps if you're uncertain, you're trying to make sense of what we've seen lately.
There's Joe trying to influence the outcome. Nice try, Joe.
Sorry. And thank you very much, everybody, for your responses, by the way. We have a great response coming through already. And let's take a look. Mostly bullish, and but a pretty fair number of you, about 37%, who are a bit uncertain.
And it's that uncertainty that I'd like to address here in the beginning of the webinar. I'd like to start out by sharing our market overview with you. We do this in our weekly market letter. So 4 years of evaluating the market. So what we're starting out with here is a 1-year chart of the SPY, the most actively traded instrument, 25 years old as of this month. Mirrors the S&P 500 index used by both individuals and institutional investors to get instant equity exposure in the large cap space. So what are we looking at here? We're looking at a market that's in hyper overextended mode, but showing no real signs of pulling back. It's pretty amazing. We've broken out above that upper channel. The bottom of the lower channel is 2550. I don't think we're going to see that anytime soon because I'm bullish on the market for 2018, and we're going to see why in a moment. On this chart, one of the things we look at to determine whether the uptrend is in strong hands or not is Chaiken money flow. Chaiken money flow has been around since 1982. Price started using it probably in 1990. It's on every one of your online brokerage platforms, Reuters, Bloomberg, if you're a professional investor. It measures institutional money moving in and out of the market, particular stocks. In this case, in the SPY, Chaiken money flow has been strong all the way back to the beginning of 2017. So in spite of the fact that the market's overextended, we had $48 billion come into equity ETFs and mutual funds in the month ending January 17th, 29 billion alone in the week. So whereas the public and some of the institutions have been cautious or bearish and parking money on the sidelines, money is now starting to flow into the market. That would normally make me nervous, except for the fact that we're in an earnings-driven bull market, and first quarter earnings are expected to be very strong. We're now in the middle of earnings season where we're seeing fourth quarter earnings and company guidance. It's all very, very positive. So our scenario for 2018 depends on understanding the trend of corporate earnings, and they're clearly up, aided by the corporate tax rate dropping down to the 22-23% area. It's also important to focus on interest rates. Now, the Fed has told us they're going to raise rates 3 times in 2018. As long as the 10-year Treasury stays under 3%, that's actually bullish in my opinion for stocks. We did break out to a new high in terms of interest rates, which means bond prices are dropping when we hit 265 on the 10-year Treasury last week. And then it's also important to understand where the sector strength and weaknesses, because there are certain sectors that do well in a rising interest rate environment and others that don't. And if you know that, you're focusing your search for profitable options trades on the long side in the right sectors, and then on the downside, there are opportunities as well in the weak sectors. And finally, stock selection. This is going to be a stock picker's market. Whereas last year, virtually everything went up. In a period of rising interest rates, active stock pickers excel. And the Chaiken Power Gauge rating mirrors what successful active portfolio managers do. So we're going to give you a tool that can help you pick stocks that are going to outperform the market, know what to avoid, all based on a multi-factor model. Now, what's the most likely scenario for 2018? Well, if you look in the upper right, you'll see that one of the 2 bullish scenarios is a period of higher interest rates and rising earnings. That all started in the third quarter of 2016. That was the case all through 2017, and we believe that's what's going to be in play in 2018. So this is a chart courtesy Bank of America Merrill Lynch, and we think that we're in a bullish scenario for 18. However, whereas we had no pullbacks in 2017, we expect that we're going to see a more normal reversion to what you're seeing in this graph, which looks at the S&P 500 going back 72 years to 1945. There have been 75 declines of 5 to 10%, an average of one a year. Typically, it's a 6% decline. It's over in a month to a month and a half, but then you recover back to new highs within a month and a half. The last 5% decline, June of 2016, the Brexit sell-off, it was about a 3-day sell-off. So here's something to really think about. If and when we get that 5% plus sell-off, it's going to feel like the end of the world. Why? Because we haven't experienced anything like that in almost 2 years. So you have to be prepared for it. Now, what does being prepared for it means? It means A, not panicking and listening to the guys on CNBC who are going to tell you it's the start of a bear market and the end of the world, because our target for 2018 at the beginning of the year when the S&P 500 was about 2670 was 2,800 to 3,000. We're already halfway into the middle of that zone, and we're not even out of January. And I think we're in a mini melt-up. There's an acronym that people are using called FOMO, fear of missing out. So we're starting to see people jump into the market. And as I said, normally as a contrarian, that would make me nervous. But given the fact that corporate earnings are estimated to be 10% higher in 2018, and that's before the effects of the tax cut. Deregulation continues, which helps the financials and small businesses, small caps in general. I believe that 2018 is going to be bullish for the market. It's also consistent with historical patterns about a strong January leading to a strong finish, and also years like we had in 2017 tend to lead to further gains, but with more volatility. So volatility is going to pick up. We're already seeing that in the options market. And I'm going to show you how you can hedge in a moment if you're bearish, if you're one of those 10% who are bearish. But the cost of protection has started to creep up again because markets are starting to get more volatile. So which sectors do well in a period of rising interest rates? They're on the bottom left, and this has been true over a 70-year period. Financials, industrials, technology, energy, and materials, these are the cyclical stocks that typically do well when interest rates are going up because the economy is strong. Consumer discretionary is sort of an outlier. It's actually doing quite well this year, so we expect that to continue, but the weak industry groups are the interest rate sensitive groups: utilities, telecom, consumer staples, healthcare, and real estate. And what you have now is real estate and utilities actually underperforming the market, as we see on this chart. This is the performance of the 10 select spider sector ETFs over the prior 6 months. And it's very consistent with what you would expect in a period of rising interest rates. The financials, consumer discretionary, again, the outlier, doing very well. Energy, technology, materials, and industrials. And right at the bottom, over the last 6 months, as the bull market has been making new all-time highs, real estate and electric utility stocks down. So you need to point yourself in the right direction to make money in the options market. Now, if you're one of those bears in the poll, here's how you hedge yourself or make money on the downside if the market declines off a peak here in late January or early February. We love vertical spreads, both call spreads for the upside and put spreads for the downside. So if you're bearish and you've got a 401k plan with 250,000 in it, or you've got an individual account with 50 or 100,000, you can put on a vertical put spread in the SPY. In this case, earlier today, you could buy the 285 put which was slightly in the money, which expires on March 9th. And reduce your costs by selling the 272.5 put against it. There's a 12.5 point spread there. So if the S&P were to drop 4%, profit potential of 275%. Total cost of the trade at that point, $334. Our options play module loves the probabilities there. How do we know that? Big green circle, a very high number, 149 with a checkbox. So if you want to speculate on the downside, this is a wonderful way to speculate on a drop in the large cap stocks. Total cost 334, potential is the difference between 12.5 and 334, or roughly $900. So a big opportunity to leverage a downside move or protect a portfolio. So for every, in this case, 228,300 of equity, multiply that times 10 if you've got a 401k plan. For $3,300, you can protect that 401k plan against a 4% decline in the market. So it's a great way to hedge, also a great way to trade on the downside. Now, we like to focus on what you need to do to be successful in trading, whether it's swing trading or options trading or your 401k plan. And one of the biggest impediments to successfully trading in the markets is that there is too much information. There's a flood of information every day in the markets, earnings reports, how they react, earnings surprises, estimate revisions, talking heads, so forth. So how do you deal with this flood of information when we're already time challenged? Time is our most precious commodity. There's just not enough of it, but yet to trade successfully, you have to process so much information. So our answer to the information overload problem, this flood of information, is the Chaiken power gauge rating. It takes all of the fundamental data on the right, cuts through the clutter by distilling it down to that gauge on the left that we call the Chaiken power gauge, which sums up the fundamental potential for a stock. I'm probably going to replace this gauge. This was done in March of 17 on Lam Research when it was 128. It moved up to 220. And here's one of the things you have to monitor if you're a trader. Lam Research reported a blowout quarter last night after the close. Better than expected revenue, better than expected earnings, good guidance for the rest of the year, 2018. Pre-market, the stock was up 5%. Where did it finish the day? Down almost 5%, a 10% swing. That's something we haven't been seeing in the first 2.5 weeks of earnings season. This is typical of the information you have to process. Still has a bullish power gauge rating, but a very negative reaction. People took profits, sold into the opening strength. So there's a lot of information to process. And we help out there by summarizing the fundamentals so that you can combine fundamentals with technicals, which I think is the path to success. So all of this is in a solution we call Chaiken Analytics for both iPad and desktop, and now we have a mobile companion. Our Chaiken Analytics members can access their portfolio, see alerts, earnings surprises, news stories on their iPhone or Android phone. We launched that this Saturday. So part of the way to deal with this flood of information is to have it at your fingertips whenever you need it. Now, we've also taken that options play module that generated that bearish vertical put spread idea in the SPY and integrated it into Chaiken Analytics. Options play has been integrated into Merrill Edge, Raymond James, Oppenheimer, Street.com, pretty soon NASDAQ. Over 2 years ago, we integrated it into Chaiken Analytics because once you find the stocks that you want to trade on the long and the short side, unless you're trading in Bryce Headley's trading room and subscribing to one of his services, which many Chaiken members do, you need a way to find the right options ideas. And we like options play because it's probability based. It does all the heavy lifting. You don't need to analyze options chains and the Greeks and implied volatility. It does it for you. So this is our way to combat the flood of information, that information overload problem. Now, as a point of validation, Chaiken Analytics has gotten some great media coverage, CNBC, Forbes, Barron's. We also have some great partners, Price Headley at Big Trends. Jim Cramer is a partner of ours, and some of our old hedge fund clients and institutional clients are using Chaiken Analytics. The same information that you have, they have access to. So we're very proud of that, and very grateful to Price Headley for supporting us over the last couple of years. Now, in today's webinar, we're going to try and help you zero in on opportunities like the one that existed back in September on Red Hat, a computer software company. So this is a one-year chart of Red Hat in Chaiken Analytics. We'll go in depth in a couple of minutes, but the key takeaway here is that we had a buy signal, one of the 6 pairs that we have in Chaiken Analytics, right before they were due to report earnings. And on this chart, we color code the previous earnings reports gray, red, or green, depending on whether they beat analyst estimates or disappointed. There was a history of positive earnings surprises. Our power gauge rating was bullish. The stock sold off into the earnings report. If you bought a call option, you would have seen the same spike up that you saw back here in March and then again in June. And these are the types of trades that you're going to come away confident that you can find by monitoring the right information. So we mentioned that we learned a lot when I was running the options department at Tucker Anthony. 250 brokers, tens of thousands of options clients. 95% of them lost money, and the reason is they didn't have an edge. They didn't understand the need for what we call a directional edge. Because if you're just randomly picking stocks and strike prices and expiration dates, you can't make money in options. You can make money in options by combining fundamentals with technicals, which is what the Chaiken power gauge quantitative model is all about, and then having reliable exit and entry signals to help you pull the trigger, because no matter how good the setups are, if you don't pull the trigger, there is no profit to be had. So we call that the directional edge, the Chaiken power gauge rating. And as you'll see, earnings surprise is one of the key factors in this 20-factor model, because stocks with a bullish power gauge rating have twice the likelihood of reporting a positive earnings surprise. Stocks with a bearish power gauge rating, twice as likely to report a negative earnings surprise. You can put that to your advantage in the options market. But summing up everything we've talked about so far is perhaps the most important message in this whole webinar. Successful trading demands a disciplined methodology. And this pyramid sums up the Chaiken methodology. We've done this in webinars as a 5-step method. My wife Sandy has mastered it, and she's just become a great trader, trying to teach her options now so she can leverage her capital when it's appropriate. But at the top of the pyramid, our most important piece of information, the Chaiken power gauge rating, it goes from very bearish to very bullish. And right under that, industry group strength, and that would include sector strength as well, because strong stocks and strong industry groups put the wind at your back and increase your profit potential. At the bottom of the pyramid, just 2 technical indicators: Chaiken money flow, which many of you are familiar with from your online brokerage platforms or stockcharts.com, and Chaiken relative strength. And in the middle, that sweet spot, the buy and sell signals, and we'll explain 2 or 3 of them in the course of the webinar. If you want to find out more about our buy and sell signals, you can go to our website, chaikenanalytics.com, and see these signals explained, whether you're a subscriber or a member of the Chaiken Analytics community or just a guest. We try and give you a little more information by describing how these signals are constructed. So in today's webinar, we're going to cover the 5 keys to profitable options trading: how to find the best bullish and bearish stocks to trade, anticipate future price movement using Chaiken money flow. I'm going to show you rules-based exits and entries, how to play good defense, very critical to avoid landmines that can destroy portfolios, and we're going to see some examples of that. And you can turn that to your advantage by anticipating these landmines and buying put options, particularly during earnings season, and then how to find high probability trades using vertical put spreads. You've already seen one bearish example of that in terms of the SPY idea. And by the way, these are all just ideas for educational purposes. We're not recommending these trades. We're not registered with any state or federal agency. So this is an educational webinar. I want you to come away with more knowledge than you came to the webinar with, and believing that there is a path to profits that sort of merges fundamentals and technicals. So at the core of everything that we've done successfully at Chaiken Analytics with our members for the last 6 years is the Chaiken Power Gauge rating. It's our go-to fundamental indicator. It's a very simple gauge, but under the surface, there's a lot of number crunching going on. So please don't confuse simple with simplistic. This is a powerful indicator that can help you become consistently profitable in the options trading or swing trading game. I like to say, and I've said it before, that the Chaiken Power Gauge is like a Chevrolet with a Ferrari engine under the hood, and it can be your GPS during earnings season. That's your directional edge. Now, Price Heatley on a webinar we did, about a year ago, summed it up as he will at the end of this webinar. Thanks for sharing so much. Your clean and simple red-green power gauge ratings, which find stocks with the best fundamentals, makes trading easier. By pointing traders to the leaders, you find stocks that you can go back to and buy the dips over and over and over again. It's a complete package. And I like the fact that it combines fundamentals and technicals for stock selection, then gives timing signals. Price, I couldn't have said it better. And as I said, we're grateful for your support, and hopefully this webinar for your big trends community is going to be as valuable as some of these have been in the past. Now, what is it that got Price so excited? Well, it's the Chaiken Power Gauge rating, which has 4 primary factors: value, growth, technicals, and sentiment. Within each of those 4 primary factors, 5 sub-factors. So value metrics are 35% of the model. They're like the foundation. Within value, free cash flow to market cap or price to sales are the most important factors. All the weights are different. And if that sounds like Warren Buffett, it should, because that's what Warren Buffett uses to pick out stocks, and obviously a very successful long-term investor. But within the model, there are some more sensitive shorter-term factors like earnings surprise. So in earnings season, you have earnings surprises, revenue surprises, company guidance. We look back over 5 quarters to see the patterns, because these things tend to come in bunches. And the important thing about earnings, I learned from a colleague of mine at Drexel Burnham in the mid-'80s, George Douglas, who did the original research in earnings surprise and how it impacts stock prices. What George taught me is that earnings surprises come in bunches. I was living in New York City at the time, so we used to say that they're like cockroaches. There's never just one of them. But more importantly, earnings surprises lead analysts to raise or lower their estimates, and research has shown that earnings estimate revisions up or down are the single biggest short-term driver of stock price movements. So within this model, you have longer-term value factors, you have growth factors, including earnings surprise, which is very sensitive but persists over time, estimate revisions, short interest, industry group relative strength. So important. Energy in the Chaiken Power Gauge rating was bearish starting in late January of 17. It wasn't until the summer of 17 when some of these energy stocks, particularly the refiners, the retailers like Valero, Phillips 66, Marathon Petroleum, saw the power gauge ratings turn bullish. Now energy is right at the top of the heap. A lot of bullish stocks from ExxonMobil all the way down to some of the exploration companies. So the power gauge rating has had a wonderful track record on the upside, but as someone once said, anybody can make money on the upside in a bull market. You can throw darts. And my response was, that's true unless it's 2014 or 2015 and your dart landed on an energy stock, because energy stocks and small caps in general were in a bear market in 2015. And this performance chart of the power gauge rating proves that. Using the Russell 3000 as a universe, the very bullish stocks were basically flat in 2015, but look at the very bearish stocks, down over 17%. If you stayed long Kinder Morgan or Range Resources or the rails that move all this liquid around, the pipelines, you got hurt very badly. So in a bull market, we can help identify the best of the best, as you'll see, but in a bear market, it's like an insurance policy against overstaying your welcome, being on the wrong side of a trade, and it can help you find winning trades on the downside by identifying stocks, as we'll see, that are likely to underperform the market. So one final proof point, and the reason I spend so much time on this is I want you to come away from this webinar believing that there is a way to cut through the clutter, evaluate the fundamentals, and still have time to enjoy life if you're trading successfully. As my wife Sandy and I do, we use her trading profits to take wonderful vacations every year. So we've partnered with NASDAQ to create NASDAQ Chaiken indices. They've been live since April of 14, almost 4 years. All 3 of the indexes which use the Chaiken power gauge rating as the final decision maker are outperforming their benchmarks significantly. So that's about long-term buy and hold investing. So the question you might ask is, I'm a trader, either an options trader or a swing trader. Why do I care about long-term performance? Well, the reality is that the stocks that are going to do best on a day-to-day basis for swing trading or options tradings are the very same stocks that tend to outperform the market over 3, 6, and 12 months. Stocks don't become outperformers in one big leap like Superman. They do it in small increments, day by day, week by week. And the final proof point, New York Life's asset management business, New York Life is the largest mutual insurance company in America, has licensed all 3 NASDAQ Chaiken indices. They launched the first ETF based on those industries, the IQ Chaiken Small Cap ETF, symbol CSML. In May, it's now got $420 million in assets, and it's the second best performing small cap ETF across the board over the last 6 months. This is not meant to be a recommendation to buy that ETF. It's meant to validate the power of our multi-factor model, the Chaiken Power Gauge rating. The large cap ETF, CLRG, was launched in mid-December. It's outperforming the S&P, and it's got over 70 million in assets. So people are gravitating to it. For the first time, money managers and their clients and individual investors like yourself can invest in a portfolio of stocks for their 401k plan, for instance, based on the Chaiken Power Gauge rating. Now, let's get really deep into the meat of how you can make money with all this intellectual property that uses the Chaiken Power Gauge rating. We have a pattern we call the classic Chaiken bulls. It's just 3 steps. Power gauge rating is bullish, which means the fundamentals are favorable for that stock. It's outperforming the market. I'm a huge believer in relative strength. The original research I did in 1967 was all based on relative price performance. Is a stock outperforming or underperforming the S&P? And that research has been validated. This is true today as it was 50 years ago, because institutional investors, except for the deep value investors, love to be in stocks that outperform the market. And the reason is very self-serving. That's how they get paid. That's where their bonuses come from. Then finally, Chaiken money flow. We want that to be strong, green, so that we know the institutions are accumulating the stock. So here's a 1-year chart of Cigna. Some of you may think, well, that's a pretty conservative stock to be talking about to a trading audience, but the reality is the power gauge rating at the bottom of this 1-year chart on Cigna has been bullish for about 15 months. And in the last 12 months, it's been outperforming the market. So this is the ideal combination. Fundamentals are strong and the market agrees with you. Because no matter how good your fundamental research is, whether it's a quant model or Wall Street research, Jim Cramer, anybody on CNBC, if the market doesn't agree with you, the market always wins. My good friend Marty Zweig, who sadly died way too young, summed it up: don't fight the tape. And then we look at Chaiken money flow to see if the institutions are accumulating the stock, and they were on balance through all of 17 as Cigna went from 145 all the way to 220. Along the way, we had those buy signals. In this case, it's our oversold buy, really simple pattern that Larry Williams, who's a sort of long distance mentor to me, came up with. If you like a stock or a commodity and it makes a new 8-day low and gets oversold, that's a low risk entry point, low risk buy area. Now we require that the power gauge be bullish. That puts the wind at your back. That's your directional edge. These signals typically work 2/3 of the time and last 5 to 10 days. So they're perfect for shorter term options trading. They're a nice swing trading entry point. And you can see on this chart in this insurance stock that some would call stodgy, which went up 50% in 2017, those lovely entry points. And then again, the earnings reports color coded because earnings surprise is part of the model with good reason, because companies reporting a series of positive earnings surprise like Lam Research did all through 16 and 17, Southwest Air did in 13 and 14. These are the stocks that the market loves, both earnings momentum investors, value investors. Everybody likes a positive surprise. So this is your classic bull. And knowing that that pattern exists is one thing. Knowing how to find the classic bulls is even more important. So for a webinar that we did on 5/24 with Price Headley, I ran this screen, taking the Russell 3000, requiring that the power gauge be very bullish. This is all in Chaiken Analytics. And then the other two components to the classic bull, money flow high, relative strength strong. And I added just one other variable. I wanted the pattern of positive earnings surprises to be strong. And within seconds, we distilled 3,000 stocks down to 13. Cigna was one of them, so was Anthem Health, Home Builders, some financial stocks. Since that May 24th webinar, the S&P 500's up about 17%, and these classic bulls are up an average of 26%, almost 1,000 basis points better than the S&P. This is how you outperform the market. If you were building a 401k, these are the stocks you want to own. If you're trading options, you want to be buying these dips in Cigna, putting on vertical call spreads, or buying the stock outright if you're a swing trader. Now, the opposite of the classic bull, classic bear. Power gauge bearish, underperforming the market. Chaiken money flow is red, not green, indicating that institutions are selling the stock. And here's our poster child for the classic bear for the last 15 months, Under Armour. Loved by the institutions. Off the charts, the power gauge went bearish at $40 about 15 months ago. Has stayed bearish the whole time. Underperforming the market, institutions selling. When they told you on CNBC that this was perhaps the time to step in and buy Under Armour, they've got a contract with Steph Curry. All the kids on the playgrounds are wearing Under Armour sneakers. Don't believe them, because bottom fishing is the most expensive sport in America. And this is living proof. You may be able to guess the bottom once, twice, 3 times in your life, but the times that you don't, the 50 or 60 other times, very costly. So we want everything in our favor. As we'll see, there's a great quote from Warren Buffett that we'll talk about later in the webinar. But Under Armour has gone from a large cap stock to a mid cap stock, and it's going nowhere. The stock was down 2.5% earlier today. You don't know where the bottom is, but these are great stocks to use for put trades. This one's probably overdone now, and you want to keep them out of your portfolio and off your bullish radar screen. Don't distract yourself with the stocks that are likely to hurt you if you trade them on the long side. So building on the classic Chaiken bulls and bears are 3 profitable patterns. And if you come away from this webinar with nothing else than these 3 patterns, your trading will improve. First one we call the dynamic duo. The second one is personality changes. And the third, stealth accumulation and distribution. And that is a secret we've been teaching professional traders and investors for over 30 years, since Chaiken Money Flow came out in 1982. So what is the dynamic duo? It's that combination of fundamentals and technicals that is so powerful. Chaiken power gauge rating for fundamentals and Chaiken relative strength for the technicals. So the dynamic duo finds big winners and losers, as we saw with Cigna and with Under Armour. One caveat though, relative strength stands alone as a bullish or bearish indicator. We'll see that when we look at a chart of GE in a few minutes. Now, what does that mean? We all know the phrase momentum stocks, or at least I think we do. If you're familiar with what momentum stocks are, please type a big M into the question box. And Joe, let me know what people are typing in, if you would.
Give it a couple seconds. Here they all come. A lot of M's coming through right now.
So momentum stocks, for those of you who aren't familiar with it, are stocks that catch Wall Street's fancy. There's usually a big story associated with them. Sometimes they have strong fundamentals, like Lam Research this year, Cigna, Boeing. And sometimes the fundamentals are just not there, but the stock keeps going up. Relative strength is strong. Problem is, if you're trading momentum stocks without good fundamentals, you're on a high wire without a safety net. You slip off that high wire because competition comes in, or Wall Street loses fascination with the stock. Cloud computing stocks sort of fall into that category. 3D printing stocks 4 years ago. Everybody remembers stocks that were trading above 100 that went down to 8. In a bull market, you fall off the high wire, and it's very painful both psychologically and financially. So the dynamic duo is really important to making money in stocks and options. So here's an example in the healthcare field. Largest Medicaid provider in America, Centene, in spite of all the uncertainty over the Affordable Care Act and whether it would continue, whether the subsidies would continue for poor and low-income families, Centene has had a dynamite year. It's gone from around $60 to $110, right at the top of the page along with the market. And notice that the dynamic duo was bullish all year. Power gauge was bullish. It was outperforming the market. And then you look at Chaiken Money Flow, and you see the institutions have been accumulating the stock all year. Now, Chaiken Money Flow can go red on a pullback. When it does pull back and it stays green like it did here in the fall, that's very bullish because it tells you the institutions are buying the stock on weakness, not contributing to the weakness. And notice that pattern of positive earnings surprises. Now, here's the second signal that I want to talk to you about. Again, very simple. I believe in KISS. Keep it simple. So this is what we call our relative strength buy signal. It happens when a stock has been outperforming the market and dips under its 21-day average, which is the middle line, and then moves back above the 21-day average. Such a simple concept, but powerful. Now, I like the power gauge rating to be bullish in addition to it, but the signal doesn't look at the power gauge rating. So these signals are wonderful for longer options trades because they last 4 to 8 weeks and they're over 70% accurate. Of the 10 biggest gainers in the S&P 500 in 2017, 8 of them had a bullish power gauge rating for all or part of 17, and there were 24 relative strength buy signals in those 10 stocks, and 23 were profitable. Think about that. High degree of profitability and a series of positive earnings surprises. So you can see these patterns repeating over and over and over again. So that relative strength buy 4 to 8 weeks, you can ride out that first move to the upper band, expecting that you'll see extended strength. Do these signals work all the time? Of course not. The market sometimes intrudes, and sometimes the game is over. But everything is looking good for a stock like Centene. Now, here's the dynamic duo on the downside. We talked about how real estate companies do poorly in a rising interest rate environment. This is Avalon Bay communities. They have communities of rental houses, and the demographics are changing. Millennials are buying houses and they're not renting as much, but REITs like Avalon Bay are also negatively impacted by rising interest rates. So the power gauge was bearish, and then you had relative strength turn bearish. We have a name for that, which is going to be the next pattern. Institutions were selling. The stock was in the 185, 190 area. And then you got a third signal. It's our money flow sell signal. This happens when a stock with negative money flow, Chaiken money flow, goes above a short-term moving average, in this case an 8-period exponential, has to have a bearish power gauge rating, and then drops back below that 8-period exponential. Again, go to our website. Don't have to write this down because the webinar is going to be mailed to you. But look at these wonderful money flow sell signals, and imagine if you had put on an options trade, what the profits would look like with a vertical put spread. High probabilities. These are wonderful trades, and this stock was down 1.5% earlier today. Again, looking to make a new 52-week low. So that's the dynamic duo. Now let's look at how you spot personality changes. This is perhaps the most important pattern of all, because personality changes are the key to making and keeping profits. And we define a personality change as a stock that was outperforming the market that begins to underperform the market, or vice versa, a stock that was underperforming the market that begins to outperform. We call that a bullish personality change. And because human nature never changes, we're stubborn. We fall in love with a stock or we love to hate it, and we don't spot those changes, and that can cost you an awful lot of money on Wall Street. So here's an example of a bullish personality change. Michael Kors, apparel stock, positive earnings surprises, but it was in a downtrend. It was underperforming the market with a neutral rating. And then they had a positive earnings surprise, and the stock jumped up because everybody was leaning the wrong way. They were bearish. And the relative strength turned positive, and then very shortly the power gauge turned positive. When you get a bullish personality change, if you spot it, you want to wait for the first buy signal. You don't want to chase that spike up. And sure enough, we got an oversold buy on an 8-day low about 2 weeks later. And look at that wonderful entry point at about 41.5 on Michael Kors, with money flow strong because the shorts were covering. And then as money flow stayed strong, you got another 8-day low here about a month and a half later, and another chance to enter the stock, this time at about 46.5. You got a positive earnings surprise. Remember what I said, they come in bunches. There's never just one of them. You spiked up, and in this case, there was no looking back. You had to be in before that earnings report. And the stock has gone from 46.5 to 66. Today it was trading at 68 at its high. This is the power of the dynamic duo and spotting personality changes. Now on the downside, cost you a lot of money if you don't see it. This is a drug stock that was a big favorite of the institutions and the hedge funds. It peaked at around 180. Power gauge was neutral, but the stock was outperforming the market. That's the example of a momentum stock. And then you got a negative earnings surprise back here in March of 17. The stock broke down below our long-term moving average. Power gauge was bearish, and then you had a bearish personality change, which means that you went from red to green on our relative strength indicator. Now, you could go to Investors Business Daily and see a good relative strength indicator, but it's a number from 1 to 99. Numbers contribute to information overload. It's easier to analyze pictures and charts than it is to read big tables of numbers. So once you had that bearish personality change, now the dynamic duo is in your favor on the downside, and you're looking for opportunities to sell the stock, vertical put spread, overbought sell signal. Look at how profitable these were. You had a series of negative earnings surprises in the stock, just like Avalon Bay, under distribution, down from 185 to 100, and the institutions are still selling the stock. And how do we know that? Chaiken money flow is red consistently for 3-4 months at a time. And these stocks are the ones that you want to avoid. And this stock was making a new 52-week low as recently as 5 days ago. Now, I promised you a pattern that we've been teaching institutional investors for over 30 years. We call it the secret sell signal that 95% of traders never see. It's the bearish Chaiken money flow sell alert. And we're going to show you this chart of advanced auto parts going back to May. It was the day they reported earnings, and just by chance, it was a day we did a webinar like this with Price Headley for the Big Trends community. So what is a bearish money flow sell alert? It happens when you make a new high or equal an old high. You formed a double top here back in January of 17. And Chaiken money flow, instead of going green, stays red. What is that telling us? It's telling us that institutions, smart money, is selling under the cover of strength. This is advanced auto parts, which peaked here at 175. Then it had a bearish personality change. The power gauge was bearish, series of negative earnings surprises. And the day before the webinar, 2 days before the webinar that we did with Price on May 24th of 17, you had gotten an overbought sell signal when you made a new 8-day high. And then 2 days later, the stock was around 150. 2 days later, you had a negative earnings surprise. The stock dropped immediately to 130, and as we'll see later, it continued on down to 100. But that's your bearish money flow sell alert. I'm going to show you 2 more examples of that in this webinar. So everything we've talked about up to now is what we call the ideal setup. Warren Buffett calls it the fat pitch. He's famously been quoted as saying, they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. In other words, wait for that ideal setup, but you've got to pull the trigger. So the missing ingredient are those 6 pairs of buy and sell signals. We've already covered 3 of them. And I'd like to show you how we find them in Chaiken Analytics. We have a dashboard. This is from our iPad app. We have one on the desktop. August 10th of 17, we did a webinar. This is a display that shows the buy and sell signals from those 6 pairs that showed up on the 120 stocks that I follow, many more than you should follow, but I'm writing a market letter, doing webinars, talking to clients. So I follow a lot of stocks, and Chaiken enables me to do that. So on that day, Boeing gave an oversold buy signal at 234.31, and Bed Bath & Beyond gave a relative strength sell signal at 29.78. We could have been looking at a momentum breakout on Michael Kors at 45 on the way to 66, or Kinder Morgan giving a sell signal, but I zeroed in on these 2, and here's what happened. The first yellow arrow is the oversold buy signal on Boeing. The stock had just reported a positive earnings surprise and gapped up, just like with Michael Kors, except that the relative strength was already strong. So you wait for that first buy signal. You try not to chase the spikes. Wait for it to consolidate. And sure enough, you got in there at 234, and the stock went up to 260, gave you another oversold buy signal just after an earnings report. Get in again, add to your position at 258 on the way to 350. Doesn't have to be more complicated than that. To trade profitably, follow the signals, because a discipline based on proven rules is better than trading on emotions. And what happened to Bed Bath & Beyond? Well, that sell signal, that relative strength signal, came where that red arrow was, and it came in the middle between 2 earnings reports. And preceding each of those negative earnings surprises, we had had a relative strength sell signal. Now, what do you think the institutions were doing based on what you're seeing in Chaiken money flow? $42 here on Bed Bath & Beyond in the beginning of 17. They're selling it all the way down to 20. And if you had followed these relative strength sell signals ahead of the earnings reports, very profitable put trades, including the one in the middle that we highlighted on that dashboard. Now, finally, the power gauge rating is turned bullish, but it's still underperforming the market with negative money flow. So I'm not buying this stock, but I'm no longer looking to short it. Trade more profitably by following the signals. Now, we talked about how important sectors and industry groups are. We've done complete webinars on that, but I want to show you in just one slide how we find those 5 sectors and confirm what we learned in the beginning of the webinar, that there are certain sectors that do well in a period of rising interest rates. Instead of looking at price momentum like we looked at in the beginning, we have something we call the power bar. It's the number of stocks in any sector, industry group, index, ETF, or custom list that you create with bullish versus bearish power gauge ratings. So just looking at the 10 select spider sector ETFs, energy, 8 bullish, no bearish. Financials, 45 bullish, only 3 bearish. Healthcare, technology, industrials, materials, all with power gauge ratings stronger than the S&P, power bars rather. And then at the bottom, utilities, 1 bullish, 9 bearish, and real estate, where Avalon Bay lives, 1 bullish stock, 20 bearish. You want to avoid the bearish sectors and industry groups and focus your long trades on the bullish ones. Use the short side for the bearish sectors and groups. Now, we talked about how important it is to play good defense, and since we believe 2018 is going to be a stock picker's market, even more important to play good defense, and very often it leads to good offense because you can take the stocks that you want to avoid and use them on the short side. So what is good defense? Well, one definition of good defense is attributable to Herb Greenberg, who writes for CNBC and Street.com and is often on TV. He said in January of 2014, it's the stocks you don't own that matter. Now think about that. We all think that we make money by finding the winners. The reality is it's the stocks you don't own that really contribute to your performance. So you want to avoid stocks in weak industry groups, know what stocks not to buy. You don't want to bottom fish. Recognize that you can improve performance by eliminating bearish rated stocks from your 401k plan, and learn how to use put options to protect your portfolio and profit on the downside in these bearish stocks. So here are 2 examples of stocks that you wanted to avoid in 2017. One of them is Allergan. Pharmaceutical stock, bearish rating, underperforming the market, big institutional selling as it moved from 260 to 215, and then it rallied up, and it rallied up for a foolish reason. So I made this my bearish stock of the week in my market letter in September, as it had rallied to 233 on some scheme to sell their patents on a dry eye drug called Restasis, which my wife happens to use, a great drug. But the generic drug makers like Mylan and Teva wanted to knock it off, and so to avoid that sort of court battle, they sold their patent rights to a Mohawk Indian tribe in upstate New York. Now, I can hear some of you laughing through the webinar because this is a scheme that was doomed to fail, and it did fail. They lost the court case, and the stock dropped from 233, where we said to short it or buy puts, all the way down to 160, almost in a straight line. And then it sort of bottomed out, but underperforming the market. Now you've gotten another overbought sell signal, just like you did when I recommended selling it. And the stock's starting to revert back to the downside. If it breaks 180, then it may go back and test that low. The point being, you didn't want to own this stock. Now, Jim Cramer, who's a partner of ours, and he and I are doing a joint webinar next Wednesday for 1 hour, just sitting around talking about stocks, has been long Allergan in his charitable trust. we've encouraged him to start using the power gauge rating, and if he had, he would have sold that stock and avoided the pain of watching it go from 250 all the way down to 160. Now, here's another stock that happens to be in his charitable trust. He's publicly admitted that this is the biggest mistake he's ever made. And Jim Cramer is a great guy and a great stock picker. But General Electric was underperforming the market all through 2017. The power gauge rating didn't go bearish, it stayed neutral. So here's an example of a momentum stock on the downside. Weak relative strength, institution selling. Here was a money flow sell alert as the stock spiked up and money flow stayed negative. And all these relative strength sell signals giving you an opportunity to get out of the stock if it was in your long portfolio and buy put options to benefit from a weak stock on the downside. With institutions selling all the way down, and then of course a negative earnings surprise just the other day. Big spike move from 19 down to 1570. Very profitable put trades if you can follow the signals. In this case, the relative strength sell signal, all 5 of them on the chart profitable. An example of a stock that you wanted to avoid in 2017 based on relative strength and money flow. So I'd like to end the webinar by talking about how to make money during earnings season. 4 times a year, companies report their quarterly earnings. There's a lot of volatility during earnings season, but that equals opportunity if you have the directional edge, and that's where the power gauge comes in. So the power gauge helps you be better prepared for earnings reports because you'll know if a stock is likely to meet, beat, or disappoint Wall Street estimates, and then you can find an options trade, highly leveraged. I'm going to talk about a stock on a webinar from last week that didn't work out, and that's why options during earnings season are the best friend you have. So here's DR Horton. This is from a webinar I did on January 24th last year. Stock had been underperforming the market in a downtrend. This chart ends in January of 17. Institution selling. This is a home builder that caters to single family first home buyer market. And they reported a positive earnings surprise on January 24th. The stock spiked up 6%, gapped up on the opening. You don't want to buy that spike, but then let's see what happened over the ensuing 12 months. Power gauge turned bullish, and in early February, you got an oversold buy signal. So you could have gotten into the stock at 32. Chaiken money flow was already strong. It then started to outperform the market. And along the way, you had lovely opportunities to buy it. I actually made it my bullish stock of the week in September of 17 when it pulled back from a high of 38 down to 36. And since then, it's been on a tear going all the way to 53. But look what happened here just 3 weeks ago. Bearish money flow sell alert. New high on the stock, and then look down there at the Chaiken money flow. In spite of the fact that the power gauge was bullish and it was outperforming the market, smart money, institutions who got in here at 32 and 36, taking profits. So Chaiken money flow never went positive. This is a wonderful opportunity to take your profits, whether you're a trader or an investor. Take money off the table because this is a pattern that often leads to breakdowns, and we saw the start of that breakdown. The home building group has been extremely strong, but one by one now they're starting to go through profit taking, whether it's rising interest rates or they've gone too far too fast from a valuation point of view. Doesn't really matter. You see a bearish money flow sell alert, you should be out of the stock. Take your profits, say thank you, let someone else worry about the next 10% move in the stock. Now we looked at Advanced Auto Parts because it had a money flow sell alert. In April, in our weekly market letter, we said, as we're waiting for earnings season to evolve, stocks are marking time, but the auto parts stocks are bearish, so sell them on a rally. They were making new 52-week lows, and I hate to sell stocks that are making lows. I want to wait for a rally. We got the rally in advanced auto parts. We got an overbought sell signal a day before the earnings were reported. Negative earnings surprise, stock gap down, went from 150 when the signal triggered immediately to 130, and then ultimately to 100 over a 2-month period. Great opportunity to make money on the short side. Now, I want to bring that chart up to date. There's the negative earnings surprise. There's the move to 100. It rallies ahead of the next earnings report, and as day follows night, negative earnings surprise. Gap down again, makes the ultimate low at 80. Tests that low 3 months later. The reason I have this chart up is that sometime in September, a really fine brokerage firm, Raymond James, downgraded the stock from strong buy to market perform. It was already down from 170 to 95. That's why you need an independent source of fundamental research, because brokerage firm analysts put their feet in cement as well. That's why we use that analogy earlier on. Raymond James is a fine stock, as you'll see in a minute, but analysts are human and they fall in love with a stock late to change. Now the stock's moved into an uptrend. Power gauge is neutral. It's outperforming the market. Don't know if it's going to go anywhere from here. The point being, you had 2 wonderful put trades, institution selling, and you don't have to wait for Wall Street to tell you what to do. You become self-sufficient. But just to give Raymond James a little love, here's a chart of Raymond James. We love this as a financial stock. Power gauge is bullish, outperforming the market. Positive earnings surprise this morning. This is why these charts that pull everything together in one place are so important, because this stock gapped up on the opening to make a new 52-week high, but you can look back and say, well, wait a minute, the last 2 times it reported a positive earnings surprise and gapped up, that was a short-term peak in the stock back here in July. It peaked at 85 and dropped all the way to 75. Then it rallied again into the next earnings report, rallied up to a new high of 87. Spiked up, and then it pulled back from 86 to 83. So armed with this chart, if you were long based on this buy signal here, oversold buy, you see a spike up in the morning, get that alert, take your profit. Even though we like this stock long term, think there's more to go, you're a trader, you take your profit, sell your options, premiums expand, you're very happy. In this case, they beat Wall Street estimates by over 13%, very strong quarter. But yet the pattern is that people take profits in stocks like this on good news. Now, here's a chart from a webinar that I did with Jim Cramer live in New York. And we used this chart because earnings were due to come out on Mattel. You had 3 positive earnings, negative earnings surprises in a row. Before the previous 2, you had relative strength sell signals. They were very profitable on those gap downs. Here you didn't have a sell signal, but you knew based on what we've been teaching you that they come in bunches. So with the stock trading around 16, you don't want to step in and guess that there'll be a positive surprise. And in fact, there was a negative earnings surprise. The stock gapped down 15% that day. It was October 26th. So these patterns repeat over and over and over again. Now, I'd like to end the webinar with a really wonderful example. Again, this is from the webinar we did with you, Price. Best Buy, which has somehow overcome the Amazon jinx and thriving as a bricks and mortar electronics retailer, had a oversold buy signal back here at 50, about a week ahead of an earnings report that was due out a day after we did that webinar with Price on May 24th. We've shown you some other examples. So you buy a vertical call spread, you get a positive earnings surprise, the stock gaps up 20%, and this is what happened. This is the spread that we recommended on May 24th based on the options play probability module, buy the June 50 call. You don't need much time on an earnings report. Sell the June 57 call. You pay $247. That's your whole risk. That's the beauty of using spreads during earnings season. Options limit your risk. And look what happened. In one day, the spread went from 247 to 692. You say, thank you very much, and you take your profit. And that's exactly what happened to one of our subscribers. 257% profit in 24 hours on earnings. Gave options one more try. I was surprised with the results. A Best Buy options trade was my biggest winner of the year. I don't think I would have ever attempted an earnings trade without the guidance in your webinars. So this has been working for years and years and years, and here are a couple more examples. 2014, Netflix. Overbought sell signal ahead of an earnings report. Stock was 460, dropped over 100 points on a negative earnings surprise. We had featured this as a bearish stock of the week. People who bought out of the money options, believe it or not, made 50 times in one day. That's sort of insane. But someone who took a saner view, John V., who was a Chaiken subscriber, a recent one, said, I recently subscribed to Chaiken Analytics, used the upcoming earnings ideas in Chaiken. Netflix had a bearish rating, bought 3 put contracts, 22.20, sold them the day after earnings for $93.90, a quick $21,500 profit. That was almost 4 years ago, 3.5 years ago. And going back to 2012, Priceline. I was on Fast Money halftime report. They asked me about Priceline. I said they're due to report. Bearish power gauge, likelihood is a negative earnings surprise. Sure enough, next day, 100-point drop. John Najarian had been long. The stock, he reverted to the put side, made 23 times on his money, was quoted the next day on CNBC saying that Chaiken saved my bacon. So these patterns have been working for years and years and years for our members, and they can work for you because we've just reviewed the 5 key steps to timing winning options trades. And all of this is part of the Chaiken Analytics platform. And to add to the accolades, and this really was a team effort, very proud of, in May of 17, we won the Benziga FinTech Award for Best Stock Ideas Platform. There were 19 other contestants in that category. So Chaiken Analytics includes this 20-factor quantitative model that's now the heart of ETFs with over 500 million in assets. You've seen the power of it. What we won the Benziga Award for was something that we didn't cover in this webinar, our stock discovery engine, where you can find ideas based on stocks you like, similar to the way Spotify finds you music or Netflix finds you films. New ideas at the press of a button. All of this is part of Chaiken Analytics. And you get the screener that we saw early on, the options idea module. And all of this is available for an annual subscription of $2,195. You can go to chaikenanalytics.com/options and subscribe. But as a webinar special for the Price Heatley fans, the Big Trend community, I'd like to take $300 off the list price, reducing the cost to only $1,895 for a 1-year subscription. chaikenanalytics.com/options. This offer expires Sunday night, January 28th. You can email us at sales@chaikenanalytics.com or dial that number on the screen, 877-697-6783. If you have any questions, we've got our whole sales and customer success team standing by. And we did a live webinar, as I said, at the Harvard Club in New York with Jim Cramer. And as I was going through a presentation very similar to this, and by the way, that webinar cost you $300 to attend, and you know this one is free. Jim Cramer was live tweeting, Chaiken Analytics model is the best. Used it at my old hedge fund. There's that 20-factor screen that you got the benefit of. Didn't have to travel to New York or write a check for $300. So in addition to everything we've looked at, you get our intraday charts, our earnings alerts, and my weekly market insights where we feature a bullish or bearish stock of the week and go into our analysis of what just happened and what's likely to happen down the road. Now, in addition to everything, as a Chaiken subscriber, you get member-only access to our weekly strategy webinar with our market strategist, John Schlitz, every Monday. You get unlimited coaching and support, including small group sessions and one-on-one coaching if you need it. And you get John Schlitz's daily morning insights, which come in before the opening, 9 o'clock, telling you what happened yesterday, what's going on in the pre-market, so you don't have to stay glued to CNBC. So one final testimonial, 10x return in 5 days from GC rather. In the 5 business days I've been using Chaiken Analytics, I've paid for the subscription over 10-fold. Please thank the entire Chaiken team, because this really is a team effort. 26 people in Philadelphia dedicated to your success. So one final inducement for you to take advantage of these tools that can help make you a consistent stock and options trader. As a fast action bonus, if you subscribe by midnight tonight, we'll take an additional $100 off, reducing the cost by $400 down to $1,795. ChaikenAnalytics.com/options. And as a additional bonus for the first 7 people who subscribe tonight, you'll get a one-on-one phone call with me. They typically last 30 to 45 minutes. Everything but give you specific recommendations. We can look at how you're trading and what's working and what's not, and give you some guidance as to where in Chaiken Analytics you can look to improve your trading results. So $17.95 if you subscribe by midnight tonight, and for the first 7 people, a one-on-one phone call. I see a couple of people have already subscribed, but before we end the webinar, I'd like to turn it back to Price Headley, who I know always has some way to summarize and wrap this up for your benefit.
Wow, Mark, you always blow me away with how much great data you can give in an hour or so. That's just phenomenal what you're sharing with us. And to give your time to the first 7 buyers, thank you for how much you give back to so many traders and investors through your Chaiken Analytics platform. What I love about what Mark shared, folks, is it's not just about finding great winning ideas. He showed you lots of ways you can find that with the Chaiken Analytics platform, with the power gauge and all the other indications that you get from that 20-factor model. But he also showed you how to stay out of trouble, how to not get, as he said, get stuck in the ones that can really burn you. That's where a lot of people make the mistakes, thinking that they can, buy low and end up selling out even lower. And more importantly, start to realize the opportunity cost on your capital. When you have the market going up this fast as it has recently, you really want to make sure you're in the leaders. And what Mark showed you with the relative strength and all the other concepts of, staying with what's working and showing you also where to avoid some pitfalls, not to mention the bonuses of the earnings-based strategies where you can make, many multiples on your money very quickly. I think it just shows you how many different ways there are to make money, and also just to keep yourself in the right sectors, the right opportunities, and out of trouble where people get stuck in the wrong sector. So, with this kind of value, you can quickly pay for this kind of incredible access in a matter of a trade or two. And so I think it's just, and on top of that, get the one-on-one opportunity with Marc Chaikin himself. We're talking about a legend in the game, truly one of the market greats. So, Mark, I just want to say thank you. Phenomenal offer, phenomenal value, and I just always learn something new from you every time I listen. So I really appreciate you sharing your many decades of market wisdom with us here today, and as look forward to many more opportunities to come.
Well, we do as well, Price, and thank you for the support you've given us and for the opportunity to share some knowledge with the Big Trends community. So with that, I'd like to turn it over to Joe Bacella to wind down the webinar. He's going to put the link up into our fulfillment page. And Joe, take it away, or close it down, as the case may be.
Absolutely. Well, thank you very much, gentlemen, both of you, and especially Mark, for the entire presentation. So again, Mark's offer is $17.95 for a full year to Chaiken Analytics. You can reach us about this at the information that's in the chat window right now. Just go right to chaikenanalytics.com/options, or again, 877-978-6257. Few things. Tomorrow we are hosting our final onboard session of the week. This is a wonderful opportunity for you to hit the ground running with the program. This session will cover all of the basics, how to create a list, how to find ideas, how to understand all of the analysis. There was a great question about a stock like Allergen, which is shown. And it was more of a bearish context, but there was a little bit of positive money flow. You're going to understand how those situations work by attending an onboard session and how to react. So we'd love to have you join us. Again, that's 877-978-6257. Until then, everybody have a wonderful evening, and we will see you on tomorrow's onboard.